Say you want to raise some capital for your first business purchase in exchange for some equity in the deal. Well, how do you get the investors to fall in love with the opportunity, and better yet, how to present the opportunity so they'll get on board? In today's video, we'll cover that, and I'm going to give you the top 10 tips on how to attract and evaluate investors. Let's get to it. Hey everyone, welcome to my channel. I am your host, Leo Landaverde, business broker and commercial lender, helping you buy or sell a profitable business. You are a small business owner looking to double your wealth by purchasing a profitable business, or you're an executive, a W-2 employee looking to leave the rat race by purchasing a profitable business, then you're in the right place. And I'm going to encourage you to subscribe to my channel. Don't forget to hit the bell, and you'll be notified every Thursday when a new video comes out. Tip number 1, money. How much money is your potential investor willing to commit to, and for how long? And here's what I want you to understand is the idea is that you should be able to come to the deal and evaluate business, and you have 10% of the purchase price. So if you're looking for deals between $800,000 to $1 million purchase price, well, we'll call it a small deal, you should have $80,000 to $100,000 in down payment plus the closing costs, but the closing costs can be amortized on the loan. So if you are looking for bigger deals, and say you're looking for deals that are $500,000 and you only have $100,000 as a down payment, and you need equity partners for the down payment, then you're going to need to raise, say, $400,000. Then you're going to need a couple of equity partners, maybe one, who are willing to help you in exchange for equity. How to calculate the equity in the deal will be the subject on another video, but they have to have the financial wherewithal to be able to afford the deal. Now, that's number 1. And actually, of all the tips that I'm going to give you, that is the easiest one, right? So what I want you to keep in mind when you're talking about money with a potential investor is that you're going to have your deal points in front of you. We'll cover that in a little bit. But what you have to also understand is that money attracts money. If you're working with an investor, chances are that investor knows other investors that are like-minded individuals. So when you tap into that pool and you're talking to investors and evaluate investors, you're going to evaluate their ability to invest in deals because they probably have done it before. So that was tip number 1. 2, goal alignment. This is very, very important. I would say it's as important as the money portion. So assume that your potential investor on this equity deal has the money to invest. Now, what is the goal? Are you aligned? So what are you trying to achieve? Are you trying to buy this purchase this business, say that is doing about $2 million in revenue, and you're looking for $100,000 because you have $100,000, you're looking for 10% or more down payment so you can get the rest with an SBA loan? Is what is the end game? No, this investor looking to park his money with you in exchange for, say, $100,000 in exchange for 10% on the deal. Now, the numbers may not be like for like, because if the business is worth, $3 million and they're giving you, $100,000, it could technically be less than 10%, but they want 10% just because they're putting their money at play. It's something you will have to negotiate with the investor themselves. What is it worth to you to have the cash? But more importantly is how long are they going to hold on to the deal? Now remember, this is a business. It's a very fragile environment. You're buying cash flow. You're getting financed with a loan for the rest on a cash flow, which means that the cash flow has to be good. So meaning that the investor, you're going to have a great cash on cash return, but you need to hold on to that investor not enough to be able to double, to grow the business, or to even double the size of the business, a potential exit strategy. So you need to know before you even tap into the investor's shoulder, what are their goals? Are they looking to invest in your business and looking for a liquidity event for the next 5 years? Usually what I see normally is somebody's going to be around for about 3 to 5 years. They're going to want they're going to give you a convertible note. They're either going to want that money eventually repaid, or they want you to cash them out at the end of X amount of years. It could be 3, it could be 4, it could be 5 years. Intricacies of which could conflict with the loan. So we want to make sure that when money is at play and you're working with investors, the money has to be equity, has to be an equity injection. Whatever you worked out with the investor outside of the deal with the SBA, it's subject for another video. So What are the goals? Are you guys in alignment to make sure that you can get to the finish line? So I would say that that's very, very important. So that's number 2. Number 3, experience. This is a biggie. Now, what experience? Now, assuming that somebody has the money and their goals are aligned, what experience do they have in the industry you're buying in? Now, so if you're buying a service business, say you're buying an electrical business or a plumbing business, this is a great business to buy. Now, does your investor have subject matter experience? Are they have subject matter expert in the industry? Are they passionate about the service industry because they either own one, work for a large corporate entity that actually was in that business? What experience do they have in running and managing the business that can actually help you scale your business? If they were the VP of marketing on a service business, chances are they have great intelligence that they can help you with, they can mentor you, that experience alone can take you a long way, not only in assuring the SBA lender that there is actually 2 people in the management team, or at least one of them that will have the experience, because experience is critical. Now, I'm going to tell you something that I hear from the VCs all the time. Now, if you go to a venture, if this was a startup and you're going to a VC, it's for money, they know that ideas are dime a dozen. What matters is the execution. And they know that the more experienced the management team is, the higher the execution. So the experience is going to be key on the execution of the plan you're going to set in motion when you buy the business. Because I'm hoping that you're not buying a business that is going to stay flat. If you're buying a $2 million business and you're paying $2 million, you're going to hope that you want to grow that business so the seller discretionary earning multiple or the EBITDA multiple will grow as the business grows. Remember, the biggest businesses that are bigger, they sell for larger multiples. Then it's very important that you understand that you want to be surrounded by people, advisors that have subject matter experience in the industry that you're buying. Number 4, reputation. Now, this is going to be easy to find. Now, when you have somebody who reaches out to you, say in the community, and they want to talk to you about investing in your business, and you don't really know them personally, you want to check them out to make sure that they're legit and they have the social proof. Do they have a LinkedIn profile? Is there, you want to Google their name, what comes up, good and bad. Do they belong to industry trade association groups? Are they part of the Chamber of Commerce? What social proof? Who backs up their story? Does everything check out? Because you're going to be associating, you're getting into a partnership agreement with somebody who's going to invest in your business. They're going to put money on the table. You want to make sure that as we talked in point number 2, that the goals are aligned, but they actually have the reputation to help you, not to hurt your business. That they are already been there where you're going, and they have the social proof necessary for you to validate them and make sure that they're going to be with you and they're going to help you, not hurt you. 5, net worth. This is a really big one. Now, so usually when you're talking to investors, you want to be talking to people who already are accredited investors, who already built their net worth over a period of time, whether they're in their 30s, 40s, or 50s, or 60s. It doesn't matter. How is their personal financial statement? Something that you're going to have to become very familiar if you're going to seek SBA lending. Because the SBA lender is going to demand or is going to ask for the personal financial statement for anyone who's going to own 20% or more on the legal entity that is purchasing the assets of the business you're looking to acquire. So they're going to see right through everybody, and they want to see everybody's personal financial statements, which what they're looking for is the net worth. It is how much is left after you after you subtract the liabilities from the assets. You want people that have good net worth of $500,000 or above, that own property, that have stocks, that own other businesses, that have fractional interest in other LLCs or business. This is the kind of success, and the success begets success. These people that are very successful and they have the net worth to back it up, because you are going to need the net worth for the collateral piece of the the trifecta that I have mentioned in other videos. In fact, there is a video that I do is how to the perfect case scenario to buy a business. If you haven't watched that video, I want you to watch it. The video link will be up here and also below. And it's because it's very important that you understand that there is a collateral piece that is associated with the net worth of a person. So say, let me give you an example. Say you have a business that you're looking to acquire that is for, say, $4 million. So the maximum loan that an SBA lender will do is $5 million. But say this is a $4 million business. You are the buyer. You're going to have a controlling interest on the new entity. So you're going to be a 51% control. And they even say that you have, 400,000. You actually have the down payment on a $4 million purchase. And this is a solid business with solid balance sheet, solid, working capital, and they actually have good debt service coverage ratio. But there is a problem. Once you liquidate, once you put your $400,000 out of your net worth, you're gonna be net worth zero, because if you don't own real estate and all you have is the cash in the bank for the down payment, think about it, and you're buying a business that is $4 million, whether it was, say it was 4 times seller discretionary earnings, so this business is netting 25 cents on the dollar or $1 million of seller discretionary earning per year. So if you follow me, this is great. But you're actually paying for the net present value. You're actually paying $4 million for a business that is going to continue to hopefully produce $1 million or more. Sounds good on paper, but the SBA lender is fronting $3.6 million loan. There is no way that the business will have the assets to collateralize the deal. So what is a lender to do? They need to reach out outside of the business itself that you're buying to cross-collateralize and to perfect the debt. How are they going to do that? They're going to reach into the net worth of all those involved. That's very, very important. When you're looking for somebody, the personal financial statement has to indicate the net worth. Ideally, what you want is somebody, a group of 1 or 2 or 3 or more investors that are partnering with you on this deal that have the aggregate net worth enough to cover the debt 100%. So anybody who owns 20% or more, if you're seeking SBA lending, anyone who owns 20% or more will have to personally guarantee the deal. So you may get some pushback from any potential investors that they may even be willing to give you some of the money, but they will not want to personally guarantee it. I totally get it. I understand it. So it's a disclaimer. So what are the options? You may get some seller carry. So, they may say, you know what, I'm willing to go along with this deal, but I don't want to I don't want to guarantee a $3.6 million. What I want, maybe we can get a non-guarantee seller carry for half, and then the SBA lender for the other half. The SBA lender will have less exposure, thus less risk. So, or a combination. But the net worth is very important. The net worth piece is very important. You have to understand it that's why you have to, everything that I've been talking about, money, alignment, experience, reputation, all it ties in together. You may have to really interview and talk to a bunch of people to make sure that you feel comfortable for those who are willing to invest and pledge their net worth to help you out. It's definitely doable, but just know where to look. You need help with buying or selling a business. If you need help, I'm here to help you. All you have to do is connect with me. Either you drop me a comment below or you reach out to me via email. My email address is in the description section of this video. Let's connect and do business together. Number 6, network. Okay, when you're having an investor, you also want to evaluate their Rolodex, their network. Remember, one success begets success. If you're talking about a successful investor and you need more than one, who they know, it's going to be very, very important. Now, who they know in terms of additional capital that can help you, who they know in terms of additional expertise that you can bring on the table for your potential board of advisors or board of directors. What vendors, if they have industry experience, what vendors, what potential clients they can bring to the table, what advisors, what CPAs, who do they know, what financial planners, their network. You are not only getting them, but you're tapping into their network. It's very important that you understand the size of the network. Now, when somebody comes through your center of influence and you've known about him for years, it's easy to assess somebody's network. But all you have to do is you go to somebody, somebody who is actually known in the industry, a subject matter expert in whatever field that they're in. All you have to do is go to LinkedIn, go to Facebook, go to Twitter, and find out what they're talking about. What network? Who's commenting on their content? Are they a high prominent business person? So you're tapping into the network, which is as equally important as the money. So that's the network. Number 7. Okay, number 7, support and mentorship. Now this is very important. Now, you don't want somebody who's going to give you, you may even get somebody that is going to give you the entire down payment. They have the net worth, the reputation, their goals are aligned, but they don't want to really get their hands dirty. They don't really want to support your mentorship. That can eventually hurt you. Now, it's hard to get it all in one package, but what you ideally want, and everything that I'm talking and evaluating is, are they willing to mentor you? Are they retired CEOs or somebody who was very successful, built their business and sold it? Now they're actually advising entrepreneurs. Those are the ones that I really like, that they really want to help you. They really want to give you the knowledge. They want to give it, not so much because they need the money. They just want to see you succeed. It's one way to perfect their investment, that the more you know, the better. But they're also going to help you along. There is a myriad of things that you're going to be facing, especially if you never own a business, if you've never been the CEO of your company. There are things that are not in your peripheral view that you haven't learned as how to evaluate risk, how to grow, how to market, sales, how to manage people, how to do government compliance, how to taxes. And you're going to need support to kind of help you. Somebody is going to steer along with you to kind of help you with the business. You're looking for support and mentorship. Somebody may be willing to say, you know what, I'll get together with you once a month, and maybe we can discuss the financials. You can show me your financials for the prior month. You can show me your goals, your sales, your pipeline, and that is what you need, because you're gonna need it more in the first year than ever. And maybe as you grow, you'll need less and less, but initially you're gonna need everything you can get. So that's number 7, support. So the last 7 tips were all about how to evaluate a potential investors. Now, as I told you at the beginning, these 3 are the most important ones. So this is how to attract potential investors. How do you become a magnet for people who want to invest and work with you and mentor you? How do you do that? Well, tip number 8 is know yourself. Present yourself in the best light. Great and concise one sheet about you. You need to be able to present who you are in a concise manner with your 30-second elevator pitch when you're meeting a bunch of investors. And you need to know that, because you need to understand your own net worth. You need to have done the homework yourself on you. You need to understand what subject matter expertise you have, what industries you're looking at. Does your resume evidence that? Do you have the LinkedIn profile that the potential investors can look at? Remember, interviews goes both ways. Trust goes both ways. You're interviewing them as much as they're interviewing you. So you need to understand what your role is in this. If you are looking to buy a business, you need to be thinking, I am going to be the CEO of this new company. Am I acting and behaving like a CEO? Does my social media reflect what I'm trying to do? Do you speak? Do you talk the talk and walk the walk? Are you going to inspire confidence? Are you going to have, things to discuss, like you understand your net worth, you understand the key performance indicators of who you are and what you're trying to do, what makes you tick, how are you going to sell yourself? The more you know yourself, the better you're going to be able to sell yourself, because you get one chance to create a great impression. If you blow it, that's something that I really work a lot with my buyers, with a buyer profile, if those who are actually looking to buy a business, because I know that in a highly competitive business, I work with businesses that actually come out to market, that there is no price. I know that if a business is listed by another broker and it has no price, means that they want the highest bidder. And businesses that have EBITDA or seller discretionary earnings of over $500,000 per year, those are going to be highly competitive businesses, and more people are going to be interested in making offers. So the better I prepare my buyer to look the best, is what you should be doing yourself when you're talking to investors. That's tip number 8. 2 more, guys. Number 9, stay with me. So, know the opportunity. Means presenting the opportunity the way an investor would want to see it. So, if I am a potential investor and I am looking at you and you're tapping me on the shoulder because you want me to invest in your business, I would want to know, tell me everything about the opportunity. What industry segment is it? Who are the top 3 competitors? What type of business? What is the historical trends? What is the year-over-year growth? What makes this business tick? What is the unique selling proposition? What is the seller discretionary earnings, or cash flow? What is the net income or EBITDA? What is the adjusted EBITDA? What is the cash on cash return? What is the cap rate? If you're talking to an investor who is familiar with concepts like real estate investor or flipping houses, and you understand that you need to talk in terms of cap rates. Cash is king. How much cash flow is falling at the bottom? All of those indicators. You need to be able to summarize them and throw them in a one sheet about the opportunity. You're selling the opportunity to the right investor. And the investor is thinking in terms of what is the cash on cash return, what is the return on my investment, over how long, and what is the opportunity, and do I want to take advantage of it? If you make it very compelling, very easy, you're going to get a better chance to try to draw it on a napkin over somebody. You need to be prepared, and you need to know it, and that is going to help you a great deal. 10, last but not least, know the industry. All right, to recap, the last 3, know yourself, know the opportunity, know the industry you want to invest in. Now, this is very important. I like one thing that Warren Buffett has always said when it comes to investors. He says, I never invest in things I don't understand. You should be keenly aware of that, because you do not want to invest in industries you do not understand. So the more you understand because of your subject matter experience, because of your life experiences, the more you know an industry, the better you're going to be, because you're going to understand nuances about the industry that an outsider would not understand. So if you have been in the government contracted business, you're going to be very familiar with bidding process and RFPs and RFIs and contract backlogs and cash flow and metrics like that, and lead times and hiring and dealing with subcontractors. I have clients of mine that are in the government contracting business. So you need to understand the industry in terms of KPIs, key performance indicators, trends. What is the average net profit of a business in this industry? So is the business you're looking at better or worse? What is the revenue per employee? What are salaries and wages as a percentage of revenue for the average? Low, median, and mean, high. What are all that? The more you know, the better, because you're gonna sound educated. So just to recap, so here are the top 10. Money, know how much money you want. Number 2 is goal alignment. Number 3 is experience. Number 4 is reputation. Number 5 is the net worth. Number 6, network. 7 is support and mentorship. Know yourself. Number 8, know the opportunity. Number 9, and 10, know the industry you're about to invest in. If you are equipped with all this, you have a very good chance of not only landing, but being very successful at your acquisition purchase. Thank you so much for watching my videos. Please comment below and let's connect. A limited time, I'm giving away my cash flow calculator. This workbook is something I use every week to calculate cash flow on deals. To figure out what is the best deal and the best offer to make, you really need this tool if you're looking for a business to buy. All you have to do to get it is subscribe to my list by clicking on the link below, and the workbooks is yours to have, and I hope you enjoy it. Thank you.